Yesterday became one of the most alarming days for global markets in all of 2025. And now, many leading analytical centers say the world may have reached the threshold of a new phase of financial turbulence, comparable in scale to the localized crashes of 2018 and 2020. What happened on the 20th of November was not a normal correction after a strong report from a single company or an emotional reaction to another set of statistics. It was a real collapse in sentiment, rapid, sharp, painful, and it happened literally within hours. In the morning, the market was soaring as if trying to break through a ceiling made of its own expectations. But by evening, that same market had fallen so fast that even experienced traders admitted they had not seen reversals like this in years. And as Reuters, Bloomberg, and Financial Times now write, this drop is not a flash of panic, but a possible harbinger of something much bigger. To understand how dangerous yesterday's reversal was, one must look at all of November. Since the beginning of the month, the stock markets had gone through an extremely unstable period. Powerful jumps upward were followed by sudden plunges, and any statement from the US government or major corporations instantly affected prices, as if the market were in a state of nervous exhaustion. The fear index VIX behaved as though expecting some external shock, and every new report became a trigger for sharp movements. The dependence on the technology sector was especially strong, the very sector that in 2023 to 2025 became the heart of global growth thanks to AI, processors, and cloud computing. But it is precisely technology that has now become the Achilles heel of the world economy. In recent weeks, experts increasingly said that valuations of many companies had gone beyond reasonable limits, and even NVIDIA's strong report, the very one that initially unleashed yesterday's powerful rise, paradoxically became the starting point for sell-offs rather than a catalyst for further growth. As analysts at The Guardian write, the market saw good news and got scared. NVIDIA's strong numbers, instead of strengthening optimism, triggered fear. If even the strongest company in the sector is showing record profits and the market is still falling, then the problem is not in the reports, but in trust in the very future of growth. The morning of the 20th of November began with euphoria. Futures were rising, indices opened with a confident jump, and the tech sector gained several percent within minutes. But within an hour, the smart feeds of major investment funds started showing worrying signals. Selling volumes were rising disproportionately to buying volumes, and large players were quietly locking in profits. CNBC later received this information from one trader who wished to remain anonymous. Large funds began exiting immediately after the market opened, as though they already knew this rise was false. From midday, the market entered a steep dive. First NASDAQ, then S&P 500, then Dow. All indices began falling in sync. By the close, NASDAQ had lost over 2%, S&P almost 1.5%, and the semiconductor index had crashed at almost 5%. This was not chaos, but a cold, rapidly organized dump, detached, unemotional, as though someone had pressed a button. But to understand the real cause of this collapse, one must look more broadly at the political context. And this is where the figure of Donald Trump enters the story, who in recent weeks has become a key factor of instability not only in the US, but in the entire global economy. In recent days, the Wall Street Journal and Politico have published a series of materials in which sources inside the White House say the Trump administration is preparing a harsh correction of economic strategy, implying strengthened tariffs, a revision of trade agreements, and withdrawal from a number of programs that ensured global stability of capital flows. In particular, the idea is being discussed of introducing an additional tax on imports of high-tech products, including semiconductors and AI system components manufactured outside the US. This instantly intensified tensions between Washington, Beijing, and Tokyo. According to insiders who spoke to Bloomberg, Trump himself is personally demanding to punish companies that manufacture components abroad and do not return production to the US. Such a statement may sound like a political slogan, but for the market it signals a threat of restructuring the entire supply chain. In a world where every GPU, server, or processor depends on dozens of countries, such threats sound like a warning that a prolonged trade war may be ahead. And if earlier such statements were perceived as political rhetoric, Now, against the backdrop of already active tariffs on China, the market understands that Trump is not bluffing. He is ready for real action. It is no surprise that against this backdrop, investors began moving en masse into cash. The largest funds started selling assets in advance, fearing that the U.S. economy could enter a period of recession with elevated rates, a changed trade policy, and an unstable international environment. All of this sounds like an intersection of multiple crisis lines, and this is exactly how the major analytical agencies interpret it now. In a report released late on the 20th of November, Morgan Stanley wrote, "We are witnessing the beginning of a structural correction. This process may continue in the coming weeks and lead to a deeper decline if trade threats intensify." But insiders on Wall Street speak even more candidly. According to Reuters, private chats of several investment houses are discussing the likelihood of a major crash that could repeat the structure of the 2000 or 2008 declines, when markets seemed strong, but cracks were already running through their foundations. And these cracks are visible now. Excessively expensive tech stocks, overvalued companies, overheated expectations, dependence on AI, delayed effects of high rates, slowing corporate investment, stagnation in the consumer sector, rising household debt. All of this forms one alarming puzzle. Yesterday became the moment when that puzzle began to flip. In addition, reports from the Financial Times state that uncertainty in Trump's policy is already putting pressure on international funds that fear the U.S. may weaken economic cooperation with several Asian countries. This means a potential risk to global liquidity and therefore to equities worldwide. And yesterday, when European and Asian markets closed in the red, it became clear that the drop would not be limited to the U.S. This is already a chain reaction. But what is especially troubling is that yesterday's decline occurred amid strong reports and outwardly positive news. Normally, strong corporate earnings reduce volatility, but this time, they became a catalyst for chaos. This means the problem is not in the data, but in the very structure of sentiment. Economists call this a state of nerve bubble, when the market is so overheated with expectations that any strong movement triggers the opposite effect. The NVIDIA example is a perfect illustration. Good news became bad, growth turned into decline, strength into weakness. And now many believe this is only the beginning. That is why many are now asking, what comes next? The answer is simple. Ahead may lie a period of deep volatility in which we will see even sharper moves than yesterday. The current market is not merely correcting, it is searching for a new equilibrium point in a world where political decisions matter more than economic ones, and where technology may not withstand its own expectations. And yesterday showed that this search will be difficult.